Hello and welcome to this talk about international financial centers. I did this last week at SIG in the economics department at the University of California in Santa Cruz. Let me get started with a little bit of review and then we'll get to some hopefully new propositions. So, just to bring you into the discussion, if you have not already encountered these sorts of things before, here is a canonical example of an international financial center. London is the canonical international financial center, and here is how a South African railway project might engage with London. When a bond issue has to be done, the South African railway project picks up a plane and comes to London. And what is the advantage of being in London? You get a sophisticated primary market. There are many global and local investors. It is easy to sell a bond issue for a South African railway project in London. And part of why it is easy to sell a bond issue into London is because after the primary market, there is a very active secondary market. There is the full ecosystem of people analyzing a South African railway project and being willing to undertake speculative trades on it and thus do price discovery. And London is an international financial center, which means that this railway project could issue in any global currency. It's not limited to issuing in Great Britain pounds. When this whole enterprise takes place, London derives a great deal of services revenues, which constitutes exports for London. Uh, Based on this, we can identify 6 components of what are called international financial services. These are things that are produced at international financial centers. These 6 things are checklisted in the slide. And my intuition is that we should think of international financial services as a subcomponent of finance that is tradable. So, for example, if you want to engage with a household from a bank branch, that's not tradable. To do business with a South African household, you have to physically be in South Africa. But in these 6 areas, fundraising, fund management, secondary market, derivatives and insurance, databases, research and training, law, accounting, and taxation, in these 6 areas, the production of the financial service can take place at a distance from the customer. And it's important to emphasize that at a place like London, all these 6 things are done in an uncompromisingly international way. You have global customers, global financial firms, you are trading in all currencies, and you've got a truly multicultural global workforce. Let's look back into history and think about how this field evolved over the years. Um, During the Napoleonic Wars, Amsterdam was destroyed as a financial center. Shortly before that, the French Revolution destroyed the aspirations of Paris. Paris was starting to come back as a bit of a financial center until the revolutions of 1848. So by 1848, London was pretty established as the world's international financial center. And the great story of London is during the first globalization, where finance and trade from the Americas to India was coordinated and synchronized by the financial system in London. And even today, London is the preeminent financial center for financial activities in Africa and Europe. After that came the rise of New York, and New York dominates, particularly when it comes to Latin America. Japan tried hard for Tokyo to build out a financial system that would serve the world economy, and I think it's fair to say that by now this is a failure, and there is not even a great attempt for Japan and Tokyo to come up as international financial centers. And finally, in recent decades, this has become something fashionable for being done at the level of a city state. A prominent success story is Singapore. Less exciting is what we have seen in Iceland or Dubai. Now, to finish with my review of traditional knowledge in this field, uh, what makes London and New York work and what went wrong with Tokyo? I feel that we have understood 7 pieces of the puzzle. The first piece of the puzzle is that finance follows trade. This is a great lesson from London of the 19th century. That when you have immense amounts of cross border international activity, both imports and exports and FDI, then all this inexorably generates demand for international financial services. For a firm located in London to do business from the Americas to India required many elements of international financial services that generated the demand, which was the anchor of how London emerged. The second element is the issue of a big hinterland advantage, particularly with New York. The financial system in New York derives enormous economies of scale and scope because they are serving a giant local economy, the United States economy, and then they are able to serve foreign customers. So the sheer size of the United States economy helps uh, the New York financial system be competitive to the foreign customer. The third issue is, of course, human capital. You want a high quality, sophisticated labor force. And I also want to emphasize it is essential to have an international labor force. No one country makes up the staff that works in an international financial center. One has to be welcoming to a global workforce. The fourth point is that regulation is an integral part of the international financial services. Here's a contrast with the conventional world of trade. When you buy an ingot of steel, you can conduct objective technical measures of how pure and how perfect that steel is. If you're satisfied with those tests, then you're done because you don't care how and where that steel was produced. The institutional environment of the place where steel is produced is not important to the man who consumes the steel. In contrast, with finance, regulation is an integral part of the product. If you have a OTC derivative that is contracted in Timbuktu, then you are exposed to law and regulation in Timbuktu. It is not possible to buy a financial product or use a financial service without being exposed to law and regulation of the home country where this stuff has originated from. So you care deeply about the legal system. You care deeply about regulation. The laws, the courts, the judges, the accountants, all these things matter greatly. And the perspective of a offshore customer will be shaped by the quality and the trustworthiness and the fairness, the neutrality of that legal system, of that regulatory system. Point number six is freedom. You can't have a financial system without the ability of the analytical community and the speculative community to be able to say unpleasant things about traded products. You've got to be able to say that XYZ company is a scoundrel. You've got to be able to say that I cannot trust the regulatory framework at XYZ exchange. You've got to be able to say that there is dodgy accounting taking place in this company. You've got to be able to say that there is a real problem with default at XYZ bond. You've got to be able to say that this bank is on the verge of default. There's got to be a very open environment where locals, foreigners are able to say unpleasant things and then undertake short selling and so on in implementing those trades. This requires a great deal of freedom. It's very easy for a more authoritarian system to squelch that freedom of speech. And if that freedom of speech is not there, then you can't get a well functioning financial system. And point number seven is English. For all practical purposes, all global finance happens in English. So, a successful international financial center needs to be one where the entire workforce is uncompromisingly English. It's always interesting for us to ask ourselves what went right in London, what went right in New York, and why did Tokyo not work? And perhaps some elements of being welcoming to a global workforce, of English, and of being an open legal regulatory system, of being comfortable with criticism. These are the things which did not quite work out in Tokyo, and that is why Tokyo did not emerge as an international financial center that could rival London and New York. Okay, with this, I am finished with my review of mainstream conventional knowledge in the field of international financial centers. For the rest of this talk, I'm going to make five speculative propositions, and I'm being very clear in saying this is speculation. These are not widely agreed upon, and these are my views, and they may well be completely wrong. My first claim is that the whole concept of an international financial center matters less in the years to come because of the way we are able to break down the overall production of finance into a global production chain. My second claim is that hiding behind every great financial system is a fiscal backstop. We need to understand it, we need to recognize it, and this has consequences for international financial centers. My third proposition is that in the future, China and India will matter in this field. My fourth proposition is that it is wise and efficient for China and India to pursue building international financial centers. And my fifth proposition is some crystal ball gazing into the next 25 years, into the kind of world that can arise between New York, London, Shanghai, and Bombay. I want to emphasize that I'm looking into 25 years. So this is extremely hazardous. I'm not making forecasts about the near future. And at the same time, I'm being very, very risky in what I say because who knows what can happen on a horizon of 25 years. Okay, so let's get started. The first idea is about a new world of breaking finance down into global production chains. In the olden days, consider a place like the London Stock Exchange. This was an exchange that traded by open outcry. For all practical purposes, to participate in the London Stock Exchange, you had to be there. A good fund manager had to be 100 meters away from the London Stock Exchange to do well because otherwise he would be cut off from the information flow. It would not be easy for him to get orders in. So the presence of the London Stock Exchange gave an impetus for the rest of the finance ecosystem to be inside the 1 square mile. So whether it was research or brokerage or an exchange or fund management, all these industries tended to cluster close to each other inside that 1 square mile of the city of London. Now that world is breaking down at a hectic pace because of the rise of computers and communications. Here's an example. I'm aware of one specific algorithmic trading firm which runs a research group in Bombay, which analyzes global data in Bombay. It writes software in Bombay, and that software is staged into a co-located data center at the Chicago Mercantile Exchange. So the fact that the CME is in Chicago does not necessarily mean that Chicago captures a whole lot of the value chain associated with having that exchange. So there's all sorts of stuff that we see being done in Bombay today. Work on algorithmic trading, work on risk management, work on quantitative research. We see insurance claims processing. We see a whole array of research and information support functions for analysts and traders located all over the world. We're seeing a whole bunch of data science. These subcomponents of global finance production are able to get done in Bombay today. Why? Because of the rise of computers and communications. You don't need to be 100 meters away from the epicenter in order to participate in the production. Now, this has one interesting implication. I said a moment ago that regulation is embedded in a financial product. But because of the ability to explode finance production all across the world, we have a reduced link between the location where high quality financial regulation and law is found and the place where the actual production takes place. So the actual production can take place at a cost efficient location as long as you have good finance skills in Timbuktu and these are available at low cost, you will move some parts of your finance production there. So whether the deep and liquid market is in Timbuktu and whether the whole complexity of fiscal, financial and monetary coordination is taking place successfully at Timbuktu is less important. And an outstanding success story of that is Singapore. Singapore does not have a big financial system by world standards, but Singapore has come to matter in global finance production. Now, how far can this go? We have seen the beginnings of this process in recent years, and I think a lot is going to unfold. So, as an example, we know that today IBM has more employees in India than it does in the United States. So, I think, can Goldman Sachs be far behind? Is it wise and efficient for Goldman Sachs to have more employees in India than it does in the United States? And probably we are coming to that kind of world as well. Um, the really important question in my mind is how far will we be able to go by talking on HD screens? Because today, the way the world works, it is very, very important to meet face to face. It's very, very important to talk face to face. The principles of many transactions are meeting each other face to face in New York and in London. To the extent that video conferencing is able to replace that, I think a lot of finance will explode further, where people will be located all across the world and are able to meet effortlessly for coffee on an HD screen. So I think an interesting speculative question over the next 25 years is what will happen to this death of distance? Are we able to do complex, nuanced conversations without meeting physically face to face? So, in the limit, I can dream of a world where all we are taking from London is the legal system. We are renting courts in London. The rest of finance production does not have to happen in London. This is purely speculative. This is not the way the world works today, but it's an interesting dimension of how things might happen in the next 25 years. Okay, my next point is about the fiscal backstop and its consequences. What was the difference between Iceland and the UK? Now, I think we've got to plan as a working approximation that in every century you will have a couple of financial panics. The state of human knowledge today does not rule out the possibility that unpleasant things will happen in a financial system. Now, when the financial panic came, Iceland did not have the ability to rescue its financial system, while London was able to do so. I think this tells us something very clear about the future of what can be done at a place like Singapore or Dubai or Mauritius. The sheer size of Singapore GDP rules out a significant fiscal backstop taking place in Singapore. And so there is something unique that big countries can do where there can be a fiscal backstop. I want to push this argument further. Suppose you construct a financial regulatory system and you're doing the mainline stuff of the three pillars of financial regulation, which is consumer protection and prudential regulation and systemic risk. Now, every country has to ask itself, what is the probability of a crisis that I am willing to accept? So suppose you're doing this in Iceland, or suppose you're doing this in Singapore. A reasonable man would say, I need to be very, very, very cautious because my fiscal capacity to absorb a crisis is roughly zero. Because Iceland and Singapore are small countries and cannot really backstop a significant financial system. That would potentially give an incentive to distort financial regulation in order to force the probability of crisis to be very, very low. I would argue that perhaps a bit of this is what we are seeing in the UK today, where for the UK, the 2008-9 financial crisis involved a fiscal outlay that was absolutely staggering compared to the size of UK GDP. In my opinion, some of the risk aversion that we are seeing in the UK is a little different from what we are seeing in the US. All in all, the size of the fiscal problem for the United States was pretty small. The size of the fiscal problem for the UK was much larger because the UK is a small country. So I think that looking into the future, we will see big, sophisticated financial systems emerging in countries which have a really large GDP because they are able to take the occasional financial crisis in their stride, as was done by the United States in 2008 and 2009. Okay, now I come to point number three, which is that I think India and China are going to matter in the future. Let's make a rough calculation. A $10 trillion GDP goes a long way in terms of producing demand for financial services. As a reasonable approximation, you will probably have a current account that will be 100% of GDP. You will probably have a capital account that will be 100% of GDP. So a country that has a $10 trillion GDP will have cross-border flows of $20 trillion a year. And on the back of that, there is a very large demand for international financial services. Now, I want to be cautious about the number $10 trillion of GDP. It is very difficult to forecast GDP into the future. Okay, all of us know that many scholars worldwide were making optimistic propositions about the future of the USSR, and this came out to be terribly wrong. Similarly, there were many optimistic projections about the future of Japan, which have come out to be terribly wrong. So I don't want to be naive in terms of linear trend extrapolation. Just because India has just finished 20 years of 9% GDP growth expressed in US dollars, this does not mean that in the next 20 years, India will repeat this kind of performance. I would put this as a question mark that if India gets to a $10 trillion GDP, if China gets to a $20 trillion GDP, then I think that there would be very large cross-border activity, and that would generate demand for international financial services, which would be a great foundation for an international financial center. Similarly, if these numbers of 10 trillion and 20 trillion dollars of GDP materialize, then in India and China, there would be the economies of scope and scale that come from serving a big domestic market. If a GDP like 10 and 20 trillion dollars does materialize, you will get that fiscal backstop. You will get the ability to host a big financial system. And there is a key twist with China and India, which is different from the emergence of the US or Japan in the field of international financial centers, which is low cost labor. So this is an additional dimension. When the US emerged as an international financial center, there was no cost advantage over London. When Tokyo tried to emerge as an international financial center to rival London and New York, there was no low cost labor advantage. Whereas in the case of Shanghai and Bombay, there is an advantage with significantly lower cost labor when compared with the incumbents, that is London and New York. Um, Is this only about the next 25 years? There are some small elements of this story which are actually becoming visible even today. Here is one table which never ceases to surprise me. This is a sorted list of the biggest exchanges of the world by the number of trades. And the number one exchange is the National Stock Exchange of India. The number five is Shanghai. The number six is Shenzhen. Number seven is Bombay. And these four exchanges in China and India are already ahead of Tokyo and London. Now, this is quite a surprise. We're discussing January 2012. We're not discussing 25 years out. Now, this is one measure. This is the number of trades. Uh, what is going on, of course, is that the dollar value of a trade in India or China is quite small and the number of trades is very large. So I don't want to overstate the implication of this table. But at the same time, it is quite a surprise that already by early 2012, China and India have a pretty big footprint in the world of exchanges, and the London Stock Exchange is already down to number nine. And this is telling us that there is a very new world that is shaping up, and it's time for us to start thinking in new ways. As a trivial example, here's one element of this transformation. The Indian National Stock Exchange is going to be 10 times bigger than the London Stock Exchange. This means that the computer technology that goes inside NSE, the entire production technology of how you build and run an exchange, uh, NSE is just qualitatively different from what you would do in London. London is a trivial small problem compared with the challenge of building an exchange in India. Now that's new. It's a very new phase in world history where the task of building an exchange in London is a trivial small one compared with the complexity of what you see of doing it in India. Um, One dimension that we should be thinking about is global currencies. For all practical purposes, today the dollar and the euro are the dominant international currencies of today. The yen has tried hard to become an international currency and has failed. The pound is not big enough to really be a big global currency. It is important today on the global stage, but it is simply not big enough. Where is China and India in this respect? These are really small currencies as of today. India is at 0.9%, China is at 0.9% in 2010. So these are small currencies. They're not remotely big by world standards and are not ready to be reserve currencies as of today. There's a fair bit of growth going on from 2001 to 2010. There's been quite a bit of action. But this is really for the future, for these countries to emerge as international currencies. I want to emphasize the four preconditions for the RMB and for the INR to emerge as meaningful international currencies. They have to have a floating exchange rate. They have to have no capital controls. They have to have trustworthy low inflation on 30-year horizons. And they have to have deep and liquid markets for fixed income and currency and the derivatives that link up all this. What the beautiful phrase coined by Percy Mistry is the bond currency derivatives nexus. And I think that there is a two-way feedback loop between becoming an IFC and becoming a global currency. If China will develop the RMB as an international currency, that will help Shanghai to emerge as an international financial center, and vice versa. If Shanghai emerges as an international financial center, that will be good for the emergence of the RMB as a global currency. Okay, now my claim number four, that it is wise and efficient for China and India to become international financial centers. The old thinking was a little different. Uh, Dooley et al. Have argued that it is wise for a place like China to build widgets and export them, precisely because the business of building widgets and exporting them does not require institutional capability. What you want is for a global firm, for Reebok, to go to a remote location in China, hire cheap labor, build shoes, and ship them out. It does not require institutional capability inside China. Similarly, Ricardo Hausmann has argued that there is an element of bad cholesterol in FDI because it's much more complex to receive portfolio investment. For me to place a portfolio investment inside a remote place like Nigeria, I have to trust Nigerian institutions. I have to trust accounting data. I have to trust the legal system. I have to trust the regulatory system. Whereas for me to build a factory inside Nigeria, I don't need much. I just need to be sure they have some modicum of political stability, that there will not be a revolution, that my factory will not be expropriated, that my intellectual property will not be stolen. So you need less institutional capability to receive FDI. So the strategy for development that was traditionally emphasized for a place like China or India was that it is too difficult to do complex finance. You should just focus on widgets, focus on the real economy, and let London be your financial system. Now, I would argue that looking forward, we need a very different perspective. Both China and India have achieved middle income status. For China and India to make progress into the future, for China and India to avoid the middle income trap, they need institutional development. It is simply unwise and dangerous for China and India to ignore institutional development from here on. For these countries to not get stuck in a middle income trap, they need lawyers and accountants and regulators and the ability to host a sophisticated financial system. And in this respect, participation by these countries in the global market for international financial system for international financial services will be a good thing. It will push their domestic regulatory and legal system. As a side effect, the households and firms in these countries will get better financial services. The third point I want to make is that despite whatever we may think about the death of distance, there is a gravity model in finance. Uh, my intuition is that if you are a $1 billion company in India, you will be pretty well served by London. You would be fine with equity and debt capital raised in London. But if you are a $100 million company in India, if you are a $10 million company in India, you really need Bombay. A good sophisticated financial system in Bombay is essential for serving the financing needs of a $10 million company, of a $1 million company, of a $100 million company. A financial system with boots on the ground in Bombay will do better information processing for anything less than $1 billion in a company in India. So, if India wants to thrive as an economy, we must host a financial system in India. And finally, of course, there is the argument that to the extent that a Sri Lankan government bond issue or a Sri Lankan telecom company issues securities in Bombay, this gives exports of financial services from Bombay. To the extent that the Vietnamese government is funding itself using a bond issue in Shanghai, this generates export revenues for the financial system in Shanghai. So, looking into the next 25 years, I think that we will see an interesting cooperation between New York, London, Shanghai, and Bombay. But we should be mindful of the immense weaknesses in Shanghai and Bombay as of today. So, I had mentioned 7 measures which are required to make an international financial system happen. I think New York is pretty much a great international financial center in all respects except one. I think the United States has a really messed up regulatory system in finance, and I'm disappointed that even after all these problems in 2008 and 2009, they have still not been able to resolve basic mistakes like achieving a merger between the SEC and the CFTC and so on. In London, I think of only 2 flaws. The first is that all in all, the UK is a medium sized economy and has no great prospect for high growth in the future. And I think this is increasingly going to be a bottleneck in the future. And the second point is regulation. The kind of fear and backlash that we see in the UK about hosting a financial system is potentially going to damage the ability of London to serve the world as it has in the last 200 years. And the other problem that London is facing is the pressures on financial regulation that are coming from participation in the European Union. So I think these are question marks about where London will go as an international financial center. But all this said, both New York and London are vastly ahead of where Shanghai and Bombay are today. And my views about the capabilities of both these cities are in the slide. These are just my opinions about what is going right and what is going wrong, both comparing across these 7 measures and across these 2 cities. When we think of China and India, there are some interesting differences. India has mostly moved towards a floating exchange rate and has started easing capital controls and has started building some financial regulatory capacity. The really big question in China is about getting away from the mostly fixed exchange rate and the mostly closed capital account. Neither India nor China has a meaningful monetary policy capacity as of today, and that is really a big project for the future. my sense is that there's tremendous human capability inside the PBOC. So when the authorities should decide to allow the PBOC to become a genuine central bank, there is a capacity in there. Now, what will this future of London and New York and Shanghai and Bombay potentially look like? I think it will be a bit different from what we saw in the last 200 years, in the sense that it was much more rivalrous in the olden days. The South African railway line made a call about whether they wanted to get financing in New York or London, and once they bought their plane tickets, the bulk of the revenue went either to London or to New York. I think that in the future we will have much more uh, of a broken down production between New York, London, and Bombay and Shanghai. And as a consequence of breaking down the overall production, there's a much bigger opportunity for Bombay and Shanghai. So even if the South African Railroad goes to London and does his bond issue there, it will generate activities in Bombay and Shanghai, which will generate revenues there. So I think that there will be much more of an interlinkage between these four production locations as opposed to rivalry between London and New York, which is what we saw in the past. There will, of course, be local advantages. There is a gravity model in the affairs of men. Shanghai will matter much more to East Asia. In the case of Bombay, I feel we will go back to an old arrangement where Bombay loomed large in the imagination of the commercial activities of East Africa and the Middle East and places like Singapore. I think those ancient relationships will come back to life if things go right for Bombay over the next 25 years. I don't want to emphasize the preconditions. At the same time, we have to be cautious that this is a very speculative view of the future and it makes seven big assumptions. And I don't want to pretend that these things will happen for sure. These are difficult challenges for both China and India. We have seen what happened with the USSR, we have seen what happened with Japan, we have seen what happened with Argentina. Many countries have gone astray in the past, and it is quite possible for China and India to go astray in the future. But if these seven things happen, then I think there is a very interesting world where Shanghai and Bombay will emerge as international financial centers. Now, when I push these kinds of seven preconditions, uh, this leads to a very interesting discussion. Do you really have these seven preconditions? And particularly in the case of China, is it possible to do this differently? Can you construct an IFC with Chinese characteristics? So, for example, can you do an IFC while pegging to the US dollar? Can you do an IFC without having political freedom? Can you have an IFC without being welcoming to foreigners? Uh, is there a greater East Asia co-prosperity sphere that is coming up where the role of China and the RMB is so great that East Asian finance will go to Shanghai regardless of these preconditions? These are interesting speculative questions for the future. As of today, when we look at the last 200 years of international financial centers, the answer is no. So, my view is that we have these seven challenges. I think Shanghai has to have freedom. I think Shanghai has to become open to foreigners. I think China has to float the exchange rate. This is my view of the world today. But who knows? Maybe the world will be different. Maybe it will become possible to construct an IFC with Chinese characteristics, and China and the RMB will be able to emerge even though some of these preconditions are not achieved. So, in short, there is mass poverty in India and China today, and I don't want to jump the gun in thinking that there is a trivial problem about achieving a say as an international financial center. But the world is changing and a lot is happening that will surprise us. As an example, it comes as a huge surprise to all of us when we see that the world's biggest exchange by the number of trades is the National Stock Exchange in India. Technology is reshaping this world of IFCs, and we are getting a new world of cooperation and not competition between big international centers of production of a broken down world of financial services production. If things go right in terms of growth and economic modernization and political modernization over the next 25 years, I think you will see a fascinating world of London, New York, Shanghai, and India. Thank you. If you find this stuff to be interesting, you might find my blog to be of interest.